Hello, guys. Welcome to class. Today is September 22nd. I originally planned to do a live class today, but I'm having issues with moving, and the internet company can't come for another 2 days. And so I had to stop by somewhere just to get Wi-Fi to be able to get this out to you guys. So, I kind of have to stick to my word. But since today is the first day of class, we're not going to really go into charts just yet. We're going to kind of go over the basics. We'll just kind of dive in here. So when you're starting to trade, okay, there are brokerages that you can choose from. So there is, TD Ameritrade. There is Tastyworks. There's Robinhood. There's E-Trade. So essentially, these are the only four that I have used before. I mean, I've used other ones, but in my opinion, I think these four will do. Let's kind of go over some pros and cons of these. So some pros of TD Ameritrade, it's commission free. It's easy, you can research easily using TD Ameritrade. It is a high quality platform. You don't have any account minimums. When you enter and exit trades, sometimes it's fast, sometimes it's not. But just know that an important thing about, choosing a platform is choosing one that is going to suit you the best. So I suggest you choose these carefully. You can use one to day trade and you can use one to swing trade, but it's kind of up to you. So it's up to you which one you want to use to day trade or swing trade. Me personally, I like to day trade with TD Ameritrade. So TD Ameritrade is best for day trading, scalping, because it's fast. Tastyworks, it's best if you want to start using spreads on options, which we'll kind of go over later on in the class. Robinhood, honestly, a lot of you probably use Robinhood. I know a lot of people who use Robinhood who are happy with it. But to be honest, if I'm going to be looking at charts and stuff, I don't want to go back and forth, going into, let's say I'm looking at a chart on TD Ameritrade and then I have to go on my Robinhood to enter a trade. I'd rather do that all in one. But for the most part, Robinhood, it's good for swing trades. You can take swing trades with Robinhood. It's seamlessly easy. The platform, it's easy to read. It's beginner friendly. E-Trade has a lot of value for both beginners and people who are more experienced. They do have easy tools to use. They do have a mobile app, but if you were to try to use E-Trade over TD Ameritrade, you'll see that TD Ameritrade is way, way better. But E-Trade, you can open up a 401k with E-Trade. You can, contribute money to this account for retirement, things like that. I think E-Trade is best for that. When we're looking at, when we're talking about stocks and options, right? You first have to kind of get, to the basics, right? Stocks versus options. So the difference between the two, right? So these are two different types of, I want to say, this is two different ways of going about when you want to trade the markets, right? One's cheaper and one isn't. So there are two different types of stocks. There are common stocks, and then there are preferred stocks. Common stocks, right, means you own the shares. Okay, shares are so when you're looking at stocks. Let's say you're looking at Amazon stock. You want to buy one stock, but it's actually one share. That's the whole. That's what it means. Okay, that means you want to buy one share of Amazon stock. So if someone you know says they own stock, it usually means common stock because these are the common names, right? Preferred stocks is basically a debt instrument of a company. So when you buy preferred stock, you're essentially loaning that company money, right? So when you loan money, they're going to give it back to you with interest, obviously. So that's the difference between the two, right? Stocks are shares of a company. So it means that you do have claims on on the company's assets and its earnings. Okay? So basically, you're just taking a piece of the big giant pie. If the big giant pie is a stock, you're taking a big giant pie. What are dividends? So dividends are payments made by the company to you, the shareholder. When you're doing research on companies, you gotta make, especially if you're just, you know, since there's two ways to go about this, you can either buy stock itself or you can buy the options. But if you were to just buy stocks itself, that essentially means that you're long term on these names, meaning you're investing for the long term. And when you're investing for the long term, you don't need to worry about options. All you need to worry about is the companies that you buy and where they are right now in terms of where they stand as a company, this and this and this. Those are the things you have to take into consideration, right? You look at the PE, the financials of the company, the ratio of this and this, right? How much debt they have. So that's like if you want to own stock, right? If you have, I think that the best, you know, the best thing about that is if you have a lot of money, right? It can produce a side income for you. That's what it did to me a few years ago, 2 years ago when I first started. I was making a decent amount of money off of just shares of buying stock. And it was, it was going up every single week because the market was doing very good that week. Now, when we're talking about stocks, right? There are what's called stock sectors, right? So essentially, the economy and stock market are organized into two tiers. The highest tier is called a sector. That's the highest tier. Okay. So basically, what sectors are is just a grouping of companies. So when you have two companies that are essentially, they don't have to be selling the same product, but if they're in the same line of work as in selling, you know, technology to people or this and this and this, right? They're going to be grouped up in a sector by themselves, right? There are currently 11 major sectors out there. Okay. Of the 11 major sectors that we're going to kind of talk about right now, right? We're going to start off with financials. Financials are banks, investment funds, insurance companies, real estate firms. This is just to get an idea of, you know, what stocks fall into this sector itself. We're going to talk about all of them right now. You have the utility sector. So a utility sector is essentially electric, gas, water companies, right? Those are the utility stocks, meaning they sell stuff that is used. For example, the difference between, electric, gas, and water, these companies like PG&E, they're all the same, but since they sell similar products in terms of what it does, it's more about, all the home stuff. That's what the utility sector consists of. We have consumer discretionary. So consumer discretionary, right? It consists of retailers, media companies, consumer service providers, apparel companies, and so on. These companies benefit when the market is what? When the market is good, right? When the market is good and consumer spending accelerates. So these companies benefit when the market is doing good. So when people are spending money, right? What they're doing is the cycle is just going faster and faster and faster. And right now, when you're looking at companies like this, some of these companies are seasonal companies, right? Some of these companies are only good for the season. Something like Boeing or something like Amazon, where it usually only has a big move during the holiday season. We have consumer staples, food and beverage companies. Can anyone take a guess on what companies I'm going to name? Also, when you're thinking about consumer staples, some of these companies, people will always go to regardless of the situation in their home or outside of their home. So essentially, when you think of consumer staple companies, they are defensive in nature. So these are the types of names that you would want to have in your portfolio if you were to have one. Next, we can look at the energy sector. So the energy sector, right, is filled with retailers, that are selling oil, this and that. So, essentially, when you're thinking about energy stocks, you could think of companies who have integrated power firms or refineries or big operations, right? So usually these companies right? These companies generate revenue that is tied to the price of crude oil. So if crude oil was to be gone, then we wouldn't have energy, nor would we even let's go over the healthcare sector. So the healthcare sector consists of biotech companies, hospital management firms, medical device manufacturers, amongst others. So you can think of stocks like CVS, Walgreens, UNH, BMY. These are essentially healthcare companies that, if you ever have a chance to make your own portfolio, or if you ever want to dive into the backgrounds of these companies, you will have a better understanding of where they belong. Look at telecom. Wireless providers like AT&T, cable companies, internet service providers, and satellite companies. Some of these sectors I don't really go through because sometimes there's no need to go through all these different sectors to find a trade, but it's helped me before in the past, and it's allowed me to make better decisions when I'm trying to make different trades, because sometimes it's kind of hard to choose, which stock you want to trade. 1 second. Sorry about that. Let's go over the materials sector. Hopefully you guys are all writing this down. So, I'm trying to kind of slow down when I speak and make sure I kind of get every single word in there. So the material sector, right? You have mining, refining, chemical, forestry. So anything that has to do with raw materials, right? That they will fall into the material sector. Real estate. So the real estate sector consists of companies invested in residential, industrial, and retail real estate. Essentially, a lot of these companies that have reals that fall into real estate, they can potentially give out higher dividends, but they're going to be a lot more volatile. So that's one thing that you have to be kind of careful about. Okay. Going back to dividends, why do companies pay out dividends? Right. So the companies, they pay dividends, right? because companies have to sell stock to the public, which is us, in order to raise money, right? So the money is going to be used for their operation. So let's say, hey, I have TCX and I want you guys to invest into TCX, right? So that means I'm going to use your money to have more assets for my company. So basically, a dividend is like a reward that's given to us for owning shares in their corporation. Okay. What is quarters, right? So we're gonna kind of go over some definitions that you guys will run into. So quarters are 3-month periods on a company's financial calendar that behaves as a foundation for the reporting of earnings and the paying of dividends. So usually at the end of every quarter, right, your broker will tell you how much you spent, what you need to work on, things like that. So day traders, that's what we are, right? So day traders are people who go into trades and sell them the same day. The purpose of being a day trader is to sell your position that same day. So, you know, you don't have to hold it overnight, things like that. Let's say you are a momentum trader. So momentum trading, which is what I do for the most part when I'm swinging stuff, when I'm swing trading, meaning when I'm holding it for, you know, more than a day. So momentum is all about waiting. What you're going to see is you're going to see charts. You're going to figure out where it might be going, or you're going to end up seeing people sorry, I think I cut off there. So when you're thinking about momentum trading, right? Momentum is about waiting. So you're gonna end up seeing a stock on your chart. You don't know where it's going. You gotta wait for it to give you a confirmation of where it might go. And then you're gonna see people who are kind of especially if you're in a chat room, right? You're gonna see people who are kind of a little bit impatient, right? So when you're momentum trading, there's less of a frequency, but when you compare it to just day trading, right? When I'm momentum trading, it's usually when I want to swing something into the next day. The reason why also momentum depends on the knowledge you have of the market or the stock itself is because you have to have a clear idea of why the stock is going to head up or down. Then you can choose where you want to exit, right? At the same time, momentum is all about waiting, but also having an understanding of what the market is like and what the stock is like. Swing trades, swing traders. So swing traders are fundamental traders. Keep in mind, there are people out there who are swinging shares, millions of dollars of shares that they're swinging there in hopes to profit. Time value allows us to have more time for the trade to play out. Okay. That's the reason why swing trading is such a, it's not easy, but it is kind of you know, I want to say it's a little bit more fun because you don't have to be on your screen 24/7 trying to find out where the next move is going to happen, but you can just, you know, plug it into a, and do it to the best of your, you know, to the best of your ability. I don't know if my like I said, guys, I just moved, so I don't have the best Wi-Fi right now because I am, you know, I am outside. I'm actually in the lounge of my apartment trying to do this. But as far as swing trading goes, you want to make sure if you're gonna be a swing trader, right? A lot of people end up trying to day trade, swing trade, and trade momentum all at the same time. I don't know if I was muted this whole time, but as I was saying, when you're swing trading, especially new people who enter the market and people who are new to the market, what they tend to do is they tend to just try to day trade and swing and momentum trade at all at the same time, which doesn't really make sense because it's like you want to learn how to shoot a three in basketball and learn how to do a layup and learn how to dunk all at the same time. You got to do it one by one because because day trading itself requires a different type of mentality than swing trading, right? Because sometimes we're quick to sell our positions during day trades, but when we're swinging trades, we have to learn how to hold things. Let's go over technical and fundamental trading. So technical, right? Technical traders, we're focused on charts and graphs, period, right? Whereas the fundamental, right? They examine things like corporate events, earnings reports, stock splits, things like that. Okay. We're not fundamental traders here. We're technical traders, right? So when we're thinking about technical analysis itself, so technical analysis, it's going to be based on a few assumptions. And I'm going to kind of, you know, narrow this down a bit instead of explaining everything to you. So one of the assumptions is the market discounts everything. What does that mean? So this means that all known and unknown information in the public is going to be reflected in the price of the stock. So whatever is already out in the news, it's not gonna all it's usually not gonna change the price of the stock because the price of the stock is already what it is because of the news. So if you think that the news is gonna help the stock go up, the stock has probably already gone up the past few days because the market was already anticipating that news, right? So number two, the how is more important than the why. The how is more important than the why. So this is also an extension to the whole market discounts everything, right? As a technical analyst, we don't care about why it's happening, right? As long as we know how the price reacted to that. Number three, Prices move in trends. Okay. So all major moves in the market is an outcome of a trend. Number 4, history tends to repeat itself. What does this mean? Right? When history tends to repeat itself, this means that just like how you're going to learn about candlesticks and you're going to learn about charting patterns, you know, this and this and this, the reason why they exist is because they continuously form, right? We're looking at bull flags all the time. We're looking at ascending triangles all the time, right? They are always happening. So history is always going to repeat itself because of fear and because of greed, okay? When we're trying to choose stocks, there is a few ways. I'm going to show you, I'm just going to explain to you the most basic way that you can do this, right? One, a way of finding a stock to trade is having a niche. So when you have a niche, right, what's your niche? So let's say you want to focus on the tech sector. So that means that is your niche. That means you're going to be focusing on stocks that are within the tech sector and those stocks only. Or let's say you want to kind of see what the health sector is about. So that means you're just going to pay attention to the stocks that are within the health sector, right? So that's one way of finding a stock. Another way you can do is you can use screeners. So screeners allow you to see real-time percentage increase on different stocks. Excuse me for my writing. Usually I don't like to use screeners because I already know what I'm going to trade every single morning. Why is that? Because I'm only trading stocks with high volume. How do we find these names? So, right, we have an ETF called SPY and we have an index called SPX, right? So SPY and SPX is essentially the same thing, but what I kind of look for is I just trade the top 10 to 15 to 20 stocks in the stock market itself. And when I narrow it down to 10, 15, 20, it's easier to find out what I want to trade the next day. So I don't have to be scattered and all over the place and not understand, or end up missing a move or end up, just trying to trade some nonsense that doesn't even have volume to begin with. So that's something that you have to think about. Liquidity. When we're looking at liquidity, right? What is liquidity? Liquidity is a measure of how many buyers and sellers are present. So when we're talking about liquidity, right? This is another major thing too. If you just want to choose random stocks, you can't just trade them because they don't have that much liquidity. There needs to be liquidity when you're trading a stock so that you can get in and out of it, right? The higher the liquidity, the more trading activity that stock has. And the more trading activity that stock has, the easier it will be for you to get in and out of a trade. Now, volatility is the amount of price change a stock experiences over a given period of time. So when we're talking about volatility, we're talking about how fast the stocks move, right? High volatile stocks include Amazon, Apple, Tesla, Roku, Google. These are high liquidity stocks. So when you enter a trade, you should not have any problems with being able to be filled in for that trade or not. So when we're trading options, right? Options are considered a low capital, high risk, high reward. Now, this sounds dangerous because it is. Even though you only lose however much money you put in, right? You can lose it fast. So something that you need to be aware of is you need to take this slow because sometimes people get burned. When we're looking at options, right? So options are contracts, right? It allows you, the investor, right? In quotations, to buy or sell a stock at a certain price. But if you want to buy it at that certain price, you have to buy a contract, right? And that what that contract does is that contract will go up in value if the stock that you picked goes in the direction that you want it to, either up or down, okay? Every single contract equals 100 shares. So every single time you trade a contract, you're trading 100 shares. That's why you're making so much money so fast, because every single contract represents 100 shares of that stock. So there are call options and there are put options, right? Call options and there are put options. A call option means you want the stock to go up, and a put option means you want the stock to go down, right? Vice versa. When you're choosing a contract, you're also going to be choosing a strike price, right? So let's say we're looking at Apple and it's trading at $100, and we think Apple is going to go to $106. So what we're going to do is we're going to buy an option that says Apple 105 call, meaning, right, the strike price is the price in which we choose to become long or short, right? So we're choosing a strike price of 5. So the difference between this 105, right, since it is pretty far together, and since Apple, does move pretty slowly, they're going to end up buying this for much cheaper than you are buying this, okay? When we're talking about options, right? Option strikes, are made up of intrinsic and extrinsic value. So when we're talking about extrinsic, we're talking about time, and we're talking about volatility. What about if we're talking about extrinsic? Or intrinsic, I'm sorry. If we're talking about intrinsic, right, we're talking about the current value of the option, meaning how far in the money it is. What is that term? So let's say you buy this Apple $100 call, you buy it, and then you sell it, and Apple goes up $7. That means your call option went in the money because now, right, it's above the strike price that you chose. I hope that makes sense. Options are decaying assets. Okay. So, meaning options expire. Options have an expiration date. When you're trading options, you must be careful about, entering trades too harshly or entering trades too slowly or exiting trades too slowly, this and this and this, because anything can happen. Be realistic with what you expect out of your trade, right? Because stock trading and options trading are different. You can explain stocks to a 5-year-old, but you can't explain options to a 5-year-old. Options have a lot of aspects to it, right? When you're thinking about options, you're going to be thinking about the pricing, the strategies, expiration, time decay, and the Greeks. We'll go over the Greeks tomorrow, and I'm sure I'm going to have better Wi-Fi tomorrow. But when you're looking at options, right, you want to make sure that you have everything in line before you're ready to take that on. So as we were talking about extrinsic, intrinsic, and why that matters, as well as time value, right? When you're looking at extrinsic, intrinsic, and time value, the reason why they matter is because they help investors understand why we're paying for an intrinsic, right? Because it's representing what the option would be worth. The time value represents the possibility of the option increasing. Extrinsic value helps you figure out what can affect the options. So when we're looking at extrinsic, right, what can affect the options? Are we talking about, Greeks, or are we talking about external factors, right? It can be both, because if the Greek is showing you that the option might go up $1, right? Then that is an extrinsic factor that is, kind of making a decision for the option to be worth something else. Let's look at delta. The delta value of an option, right, is going to be expressed between -1 and 1, right? So if you have a contract like this, and we're going to go over more of this tomorrow, just so that you can kind of get, in the field for this. I apologize again because my internet's not so good right now. And, I've had a very, very fucking long day, and I'm still doing this because I have to. And so, if any time during this class, I cut off or anything, just bear in mind that, I still couldn't even get my things going in my new place. So, which is, everything is kind of everywhere right now in terms of what I need to do. But like I said, if this isn't making sense to you yet, just wait until the next few classes, which, is going to start clicking. Sometimes it's harder to understand options, so bear with me. So the delta of an option is going to be -1 and 1, right? So this number, right? Let's say we're looking at an options contract. This number delta, let's say the number is 0.50, right? So since we're trading options, if we buy one contract of this, this means we own 100 shares. So what you're gonna do is every single time you have the Greeks, every number next to the Greek, you're gonna multiply that by 100. So this means that if I multiply 0.50 by 100, right, that means I'm going to make what? $50 or 500? If you got $50, you're right. So that means the stock option contract that you just bought for $100, if the stock goes up $1, it's gonna be worth $150 now, because the delta ends up going into your pocket. The delta ends up adding on to how much it costs you to buy that, if you know, the contract. The delta will always change based on market conditions. It will increase as an option gets deeper into the money and decrease as it gets further out of the money, right? Extrinsic value of an options contract will always diminish over time as the option expires, right? Now, when you're looking at theta, that's what that is. So if you're looking at theta, let's say the theta is 0.30. That means every single day you hold your option, you're going to be down $30 every single day, right? Every single day until you sell it or until it expires and it's not going to be worth anything, right? We're not going to go over Vega yet because it's too confusing for you guys, for some of you. So we're going to kind of pick this back up tomorrow. Today was just kind of an introduction of, you know, just a lot of easy basic stuff that I just wanted to get out of the way. Honestly, I like jumping into charting and I like jumping into strategies, but I felt like I had to go this far back in order to kind of get everybody on the same level. So I hope you guys, you know, took the time to take some notes, and I am going to have something for you guys to read tonight so that we can be prepared for our next class. And I appreciate you guys for listening.